Inflation here is proving much more stubborn than hoped, with food prices still going up and wages now chasing to catch up to. And that means people paying thousands of pounds more for mortgages and the government paying billions of pounds more for our huge debt pile. And all that could also mean a recession on the way. So a really cheery morning for us. Well, we can speak now to the former Deputy Governor of the Bank of England, Charles Bean. Thank you very much for being with us.
Good morning. You've cheered everybody up.
I know. I feel a bit guilty, to be honest, actually, by how depressing the situation is. But it does feel quite depressing.
It's certainly a tricky situation at the moment for the bank and for the government, for that matter, because inflation has been stubbornly high. It's surprised very significantly to the upside in the latest data. And if you look at underlying inflation measures, they're even more concerning. Pay growth, which is running about 7.5% in the private sector, is way above what's consistent with the inflation target, which would need to be around about 3.5%. Now, we know why it's high, because people are trying to catch up for the hit to their cost of living. Yeah. So even though you've got pay growth of 7.5%, it's still not enough to prevent some fall in real living standards. But it has the effect of perpetuating inflation going forward. And because the labour market is historically really still quite tight, workers are in a position to get those higher pay awards. And the bank will just have to keep on tightening policy until it takes enough steam out of the economy and generates enough slack in the economy to cool inflationary pressures.
So to keep squeezing until we get to a recession, effectively?
Well, how much it will have to squeeze is an open question. Economists often use an analogy of policy of it's like having an elastic band around a brick, and you pull it, nothing happens, then all of a sudden
it comes
at you.
Yeah.
And they'll want to avoid overdoing things, but I think it is very difficult to see an environment where we at least don't have continued stagnant growth for quite some time, and quite likely we'll need some modest contraction at least.
Now, I'm no economic expert, right? So guide me through this. It's pretty clear the government is focused on bringing inflation down. That's its number one priority. But obviously the flip side of that is people saying that wages need to be squeezed, that mortgage rates will go up, that we could see a recession. Is that worth it to bring inflation down?
Well, at the end of the day, yes. I mean, what we know from past episodes of inflation in this country, in other countries, is the longer you leave it and the more it gets embedded, the more nasty it is when you finally squeeze it out.
And is that what we're seeing now? Because the bank was a bit slow, it's nastier?
Well, I would, to a degree, defend the bank because, of course, the main reason we have high inflation is because of the external price shocks associated with the war in Ukraine, the rising gas prices, global food prices, also supply chain pressures as economies reopened after the pandemic. But that said, I think they were a little bit behind the curve, and they certainly persisted too long with quantitative easing through the tail end of the pandemic, and they should have been starting to withdraw some of the extraordinary stimulus earlier.
So that actually increased inflation as well?
Well, it's potentially added to it. I wouldn't put it as the primary cause, but it has helped to explain why the labour market is quite as tight. The other thing that is worth mentioning here is we've lost 500,000 workers who've left the labour force as a result of the pandemic, mainly older workers. And that means, of course, the economy hits up against labour shortages earlier than would otherwise have been the case.
Has Brexit had an impact as well?
It's a bit of the story. It's not the main part of the story. There's lots of additional factors. The minimum wage is another part of the story too. What's clear is that as far as Brexit is concerned, some foreign suppliers, European suppliers, have felt less inclined to supply the UK market, so food markets are less competitive than they will otherwise be, more expensive suppliers and so on. And there's more costs from that still to work through because we haven't fully imposed all of the controls that are supposed to be in place now. We've left the single market.
I want to talk a bit about mortgage rates. We've obviously got the Bank of England's decision on Thursday, likely another increase in rates. Just how high do you think interest rates are likely to go?
I think it's difficult and I'm always very wary of doing that because it depends on the data. What the bank will want to avoid is pushing rates up high and then having to backtrack in short order because that would be an indication they've overdone it. I think rates will certainly go higher from where they are, reflecting these bad inflation and pay and labour market numbers that we've had over the past month. How much higher they have to go is open. Obviously, the markets are expecting significantly higher rates, not too far short of 6%. I wouldn't rule that out, but it's not necessarily baked in by any means.
And if you did have a vote, would you be voting to increase interest rates?
Oh, if I was still on the committee, I would certainly be voting to raise again. And it's worth saying that there is another inflation release next Wednesday ahead of the policy meeting. Normally, data releases an individual data release doesn't carry that much weight, but this one might be particularly significant because it may, if it's a bad one, persuade more members to vote for 50 basis points rather than 25 basis points.
So it could go up to plus 50?
It could. My expectation, my central expectation, is just that they'll rise a quarter of a percentage point. But it's not impossible. They may decide to go more, particularly if it's a bad inflation number next week.
Is there anything the government can do right now to try and help the situation?
There's not a lot they can do to influence the overall macro environment in a favourable way. There may be things it wants to do to alleviate pain on particular parts of the population, poor households or whatever. There obviously have been some calls for protecting those with mortgages. I think that's risky territory to get into because, of course, if you do that and reduce the pressures on those with mortgages, that reduces the extent to which the economy slows and just means the bank has to raise interest rates even more. So any government action would have to be very judicious, I think.
It feels we're in a weird situation where the goal is to slow the economy down. It feels kind of counterintuitive.
Yes, but it's because the economy is essentially operating at an unsustainably high level of activity at the moment. Because what the government really wants to do is get the underlying growth rate up. And you know that's the magic bullet. Faster productivity growth. If we can get more people participating in the labour market, then that would also help because that would generate some slack, some extra workers, and take some of the pressure out there. And that was the one glimmer of good news I thought over the past month in the latest labour market release. There was a noticeable uptick in labour market activity, partly reflecting some older workers coming back into the labour force.
I'm going to leave it there because I feel like if there's even the smallest slither of good news, it's quite a nice place to end after the programme that we've had.
Well, hopefully next time you invite me back, it'll be a better outlook.
Should we try and do that? Do you think inflation is going to be coming down then? Will they meet the target to halve it by the end of the year?
I'm pretty confident that inflation will come down. Almost arithmetically, it has to come down from the close to double-digit levels it is at the moment. The question is how stubbornly it gets stuck around about 5%.
OK, thank you very much. Really interesting to talk and guide us through some of the important things that are happening with the economy.
You're welcome.
Thank you.